All right, welcome back to another video. This one we're going to talk about straddles and strangles, okay? Now, this is the opposite of the last one we talked about, where instead of betting that price does nothing, you're kind of betting the opposite. And you're betting that, you're essentially betting on volatility, that you're going to get an explosive move either up or down, okay? So you're just, now, typically, like I said, with a call, your betting price is going to go up. With a put, your betting price is going to go down. With this one, you don't care if it's going to go up or down. You're just betting there's going to be a massive move in one direction. So it could be based off earnings. It could be you think there's news coming out. It could be for no reason at all. You just believe there's going to be a massive move. That's where this is going to help you out. So the straddle, this is the classic. And essentially all you're doing is you're buying a call and you're buying a put, typically at the same strike price. So let's say the price is at $100, okay? What you would typically do is buy the $100 call and also buy the $100 put. And let's say they both cost $3. Your total debit is going to be $6, right? And again, you multiply it by 100. So it's going to cost you $600 to put on this trade. And because you're buying a debit, whatever you buy as a debit is going to be your max loss, right? So for in this example, your max loss is $600. Your max profit is unlimited, okay? Now, for you to profit on this example here, you need the stock price to go either above 106, so increase by higher than 106, or go down to 94, right? And that's how you're going to make money on this specific setup. So all you're doing is just betting that price is going to make a massive move either up or down, and if it does, you are going to profit on that trade. Now, the strangle is very similar, but it's a little bit of a higher risk reward type of setup. And essentially what you're doing is instead of buying the same strike price, you're getting further out of the money strike prices. So let's say again, the price is $100. You could be buying the out of the money call at 105. Buying the out of the money put at 95 right here. Okay, and these are going to be a little bit cheaper. So it's only going to cost you $1.50 each, and the total debit is going to be $3. So your max loss on this trade, it's going to be $300 as opposed to $600 like the last one. But you need a bigger move for this to profit. Now you need price to go all the way up to 108 just to break even, or go down to 92 before expiration just to break even. So depending on how confident you are in the move and how much you want to risk, you would either do a strangle or a straddle. Now, the risk is that IV is crushed, right? Because as we know with buying options, you're basically going against theta decay. And now that you own two options, both are losing value every day. Time is your enemy. So again, if your stock price is at $100 and you buy this, every day that goes on, if the price doesn't move, you're simply just losing money towards decay. So you really need a very fast move to happen and a very explosive move to profit off this strategy. And the other one is IV crush, right? So after earnings, if you are playing earnings, volatility will drop and your options can lose value even if the stock decides to move. You really need a very fast move for this to profit and to make money off of it. So it is a type of strategy that not everyone likes to use. But if you do believe there's going to be a big move and you want to hedge against an iron condor or a type of credit spread move, this would be a way to do it. So hope you guys did enjoy this video. Again, it's another strategy you can have in your toolbox, and I'll see you all in the next one.